This is Retire Hour.
Welcome into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape of retirement. We've got a big show for you this week, a lot of things coming up. Later in the show, we'll be talking with Jonathan McCoy, and he will be discussing a conversation he had with a customer or a client this week about the recent market volatility and is there anything you can do about it. Then after that, we'll be going out to our West Wichita office and talking with Danny Goolsby about what's keeping some of you up at night. That'll be an interesting conversation to have. Trey Bassa with Market Medicare Advisors, he'll be having a conversation of why someone had to go off their spouse's company, their employer's work insurance with Medicare. And of course, to end the show, we'll be talking with Joshua Sikora about how tax season's over with, but you really probably shouldn't forget or just maybe put away taxes because there's some legislative things coming up here that you'll want to be paying attention to and how you can get around that or maybe master that or make that work for you the best way possible with tax planning. But we're going to go back up to Kansas City and talk with Stuart Woodbury of Low Cost Life Insurance. And this is a special guest we're having this week on the show, someone outside of our firm. He called me a couple weeks ago and we were having a conversation about many things. One of them in particular, I said, well, why don't you come on the show, Stuart, and we'll talk about it. And that's how really the best use for life insurance is as a risk management tool. And isn't that right, Stuart? You and I could go on about this topic probably all day long.
We absolutely could. It's great to be with you this morning for sure. And that's exactly right. I think the main message I want to get across to the listeners today is that is exactly what life insurance is designed to do. It's to mitigate risk. All too often, those types of products, the cash value, and not that cash value insurance is in and of itself bad. The problem is when it's utilized with the intention of being an investment alternative. So we want to make sure that we're using the life insurance strategy to mitigate risk. And I always ask folks, for general life insurance planning, the following question, and I think it's pretty straightforward. If you died today and had no life insurance, does that create a financial hardship for anyone you care about? If the answer is yes, then we need to determine the amount of coverage that's appropriate, the duration of the term, and then go out on that client's behalf and locate the best product specific to their underwriting profile. And I think that's really the key. There are certainly cases where permanent life insurance, when it's utilizing an irrevocable life insurance trust, a special needs trust, permanent insurance limited, but it does have its application, assuming the focus is on risk management. It never works as an investment alternative.
And I can be a little more bold here. Sometimes you and I probably have run across either other people that would call themselves advisors or retirement professionals, and they're trying to make life insurance be everything, and it's being an investment and being a risk management tool and this and that and the other and cash value. And oftentimes that's just someone that maybe doesn't have the other licenses to offer the full suite of tools in the toolbox, and someone's trying to fit maybe a square peg into a round hole.
Yeah, and I think you can throw in as well long-term care insurance, right? They try to lump in long-term care to mitigate that risk, life insurance. Look, at the end of the day, there's no one product that solves every single problem, right? We have to do the comprehensive planning to make sure that we've offset that risk. And again, for most folks, the reason they're concerned about buying life insurance, again, is not to invest money. It's to protect if they pass away and their spouse loses their pre-death income. We want to make sure that folks have that risk offset because for most people, especially younger, when you have a mortgage, don't have a lot of money and you're in that accumulation stage, you've got young kids, right? The risk of losing that pre-death income can be catastrophic. But over time, as you pay down that debt and mortgage, assuming you don't at like 60, my age, build a dream home. But at the end of the day, we want to pay down the debt over time. Most people achieve financial independence not by selling a company, for $50 million or whatever the case may be. Most folks accumulate wealth over time, investing small amounts of money. And that's generally how that goes. And so we want to do everything we can on the risk management side to increase their probability of success at retirement. Once you get into your early, certainly mid 70s, for most people at that stage in their life, they've got plenty of money, right? They no longer have any debt. Their kiddos are hopefully financially independent. That's a separate issue. But all joking aside, we want to make sure that those risks are offset. But once you get to that point, you can ultimately self-insure and replace the need for the life insurance with assets.
Yeah, I just had,
and it's really no more complicated than that.
and you're right. And then there's kind of the examples where maybe if you haven't had the house paid off, or like you said, you get up there in age. I have a couple, I think he's 68 and she's 66, 67. They both have pensions and not much in the way of a nest egg, but because you mentioned this earlier, they're so reliant on that income, they do have some term policies on each other where if something happens to the other spouse, there'll be this lump sum of money that hopefully you can invest and go get some replacement income off there, because as in retirement, if they don't have much in the way of a nest egg and they're relying on Social Security and the pension, and one of those spouses passes away, there's going to be a drop in income, and that's the perfect answer for life insurance.
And we had a client just a couple of weeks ago that it was exactly that. They were in their mid 60s, and the concern was, listen, if I pass away, we really don't have, unfortunately, we don't have a lot of assets accumulated. The overwhelming majority of retirement income was based on the pension, and unfortunately, on this particular client, they did not have a survivor benefit on the pension for their spouse. So although obviously in today's market, pensions have kind of gone away, but there's still a lot of them out there, right? There's still a lot of folks out there that are hearing this message, going, "Oh my gosh, what do we do if there is a survivor benefit? Is it 100%? Is it 50? What if it's 50% and that's cut in half? Is there risk?" And so as far as losing that income and what the financial impact that would be created. And again, so life insurance is always ask yourself, if you did not have the life insurance coverage that you have, and maybe you need more at some point, maybe you need less. But for most folks over time, the goal is to self-insure that risk, right? And so over time, you can phase it out. But if you ask yourself that question of, man, what if I died today and I did not have this insurance policy, whether it's earned income from working, whether it's a pension income, if that loss of income creates any type of financial hardship, that's definitely something to address.
That's so right there, Stuart. And we appreciate you coming on the show, and we'll have to have you back for more. We're out of time here. But if you are thinking to yourself, man, I really could use someone to walk me through my situation to see if I'm okay or if I've got my risks handled. If you're in the Kansas City area, you can reach out to Stuart at lowcostlifeinsurance.com, or you can call Market Advisory Group at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can go over to our website at retirehour.com. Well, stay tuned. We'll be right back with more of Kansas City. We'll be hopping over to Jonathan McCoy over at 95th and Null. Stay tuned. We'll be right back after this. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. I'm Matt Goolsby, and I've got to get my dad joke in here. I did not get this in last week. I wanted to. With all the ups and downs that have been going on in the market, I've been saying the markets are tariff-fied. Ha, 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 ha. You get that? Tariff-fied. Okay. We're going to go over to Jonathan McCoy in Kansas City up there in Overland Park, and you have a story to share with us about this recent market volatility, and is there anything anyone can do about it?
Well, ultimately, we know that financial advisors nor investors alike can control the market. Ultimately, what we're focusing on from a planning perspective is what position were you in as we led into this volatility in the financial markets, and finding that some people maybe feel like they were left a little unprepared, either by the investment management strategy that they had, or they're approaching retirement, and had not accounted for inside of their investment portfolio, making sure that they had maybe some safer assets to allow them a little more financial freedom, even if the market does go through a more prolonged downturn as they're entering their retirement years. So a lot of the focus that we have with our existing clients that are investing with us is, this is why we put some of these plans and positions in their investment portfolio in place, is because we know the market is going to go through volatility and downturns similar to what we've seen this year. The question everyone has is this kind of right on the verge of a normal correction, those 10 to 15% pullbacks, or could this lead into a more prolonged downturn where we're looking at those 20, 30, 40% pullbacks in the market? At this point, it's anyone's guess ultimately. But I think for a lot of folks, it's a matter of reevaluating the financial position that you're in, especially if you're entering or already in retirement, to make sure that you've got some assets that you can live on from a safe perspective if the market does continue through a more prolonged downturn.
And, we talk about the retirement red zone all the time. We credit that to Larry Clefcorn, one of our advisors here. And if you're approaching retirement, you really need to be paying attention to this volatility. And maybe if you're already retired, that's even more reason to be paying attention to this volatility. But we saw a really hot jobs report from ADP on Wednesday where it overshot, expectations. You're seeing some cracks in the economy, but then the Fed's saying, well, we can't really lower rates. We don't really know what's going on. There's a lot of uncertainty out there right now, right?
Yeah, that's exactly right. And like I said, we don't want to leave ourselves in the position where we're trying to make investment management or retirement planning decisions based on what we think the market is going to do. That's a very speculative way to manage money from the get-go. And I think a lot of it is putting in place inside of your portfolio multiple buckets of assets that, you've got some longer term, more aggressive money that you don't expect to have to tap into for maybe 10, 15, 20 years down the road. You've got some more moderate risk investments that if you needed to in the event of an emergency, you've got access to those funds. And then you've got some more conservative or safe funding assets that can supplement income through the period of, a year, 2, 3 year market downturn. Or better yet, making sure that you've got better guaranteed sources of income leading into your retirement years to make sure that you're not forced to have to pull out of stock market based investments while the market is down, because that's the number one reason why people are not able to allow their portfolio values to recover after a downturn, like we've seen many years in the past, especially after like a 2008 financial crisis scenario where people are having to pull money out of these retirement accounts when they've already taken these large losses. To us, that's a representative factor of not being as well prepared for these market downturns. We talk a lot about dollar cost averaging while you're saving money, but dollar cost averaging, as you're pulling money out of those retirement accounts, can sort of work in reverse and make it much more difficult to recover from even short-term downturns like we're seeing today.
I'm hearing a theme here. It's almost like we scripted this show out. We started off the show with Stuart Woodbury of Low Cost Life Insurance, talking about how life insurance can be used as a risk management tool. And it seems like you're talking about risk management for people's retirement nest egg and retirement income. Am I on point there? Or?
That is exactly right. And, I think a lot of people, they stop the conversation around risk management with, some of these questionnaires and things that you might go through in terms of what is your risk tolerance. Well, your risk tolerance is one factor in this whole puzzle of building a retirement investment plan and retirement income plan, but actually financially, how much risk can your portfolio tolerate itself in terms of if and when the market goes through these larger downturns? How sustainable is that? How able are you to continue to generate income off of those retirement savings? And this is a big part of our MAG report process, is stress testing your portfolio to say, okay, well, if you left things alone and continued managing money the way that you do, is there something, or is there a market event that could cause, long-term catastrophe or at least damage to your portfolio by not having the appropriate risk management strategy in place?
Yeah, I had someone else in my conference room this past week, and they were talking about how, well, Matt, I've seen this happen before in my career where the market goes up and then it pulls back and it goes up and pulls back. It comes back, but I'm concerned that maybe what if it takes longer to come back than with COVID? I mean, the financial crisis, 2007, 2008, it took 6, 7, 8, 9, 10 years, depends on how you were invested, to get back to quote unquote even. But then you have those 6, 7, 8, 9 years where are you just not taking money out of your nest egg? Or are you just living like a pauper, eating dog food? That's not what we want for anyone, right?
Yeah, that's exactly right. And I use the analogy all the time, and it's probably getting a little bit old around the office here, but we don't want the tail wagging the dog, and the tail being the financial markets overall, the dog being your life, your lifestyle, and the expectations that you have of what each and every year looks like from a lifestyle perspective for you. Otherwise, why do we retire to go and do the things that we didn't have time to do while we were reporting to work for those 30 or 40 years? If the financial markets are directing in a very pertinent way the decisions that you're making in terms of the travel that you do, being able to go and visit family, whatever that lifestyle looks like in retirement, we don't want to leave our clients in a position where the financial markets, especially during a downturn, are dictating what our clients are able to do with their lifestyle in retirement.
Thanks, Jonathan, coming from Kansas City there. And if you guys are listening or watching this show, however you're getting this program, and if you're thinking to yourself, man, I'm concerned I don't have a plan, or maybe you're anxious that you don't have a plan, or maybe just all the recent market volatility has you concerned with how this could impact your retirement. And if you want to know more, just reach out and schedule a 15-minute call with us today. You can do that at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. And like Jonathan McCoy was saying there, we can take you through our full-blown process, or sometimes people just need that 15-minute call just to get a sense of where they're at in their situation. Well, stay tuned. We'll be going over to West Wichita talking with Danny Goolsby about what's keeping some people up at night. Stay tuned. Again, we're continuing this theme here this week on Retire Hour of risk management. We were talking in that first segment there with Stuart Woodbury of Low Cost Life Insurance out of Kansas City about how using life insurance can be a risk management tool for if you're dependent on that either pension or income, Social Security check from your spouse. If something happens to them, you want to make sure you're going to not have to change your lifestyle. Jonathan was talking about the recent market volatility and how that some of the people he's meeting with, that's having some concerns there. So we're going to pop on over to West Wichita now. And this is the first time we're having Danny come from the West Wichita office remotely there. I've been all alone in the booth this morning. I'm getting lonely here. We're going to have someone come in after the bottom of the hour break here. But Danny, you said, you kind of said in your pre-show notes here, what's keeping some of our clients and potential clients that we meet with that come to our classes or watch us on TV or listen to this show, what's some of the things keeping them awake at night right now?
Well, in no particular order. So Jonathan and Stuart both were talking about risk management issues, and that theme continues with the different things that we run into when we sit down with a client or with a prospective client. We'll often start out the conversation saying, "Hey, thanks for coming in. What prompted you to come to a workshop? Why are you here today?" And you'll get various things coming back at us. Well, for example, some of the things that Jonathan may have talked about, or maybe they'll talk about, hey, what happens if the interest rates start to go back down again? Because I'm living off of interest, and the interest rates have been good for the last 18 to 24 months, or at least better. I'll say it that way. But now the Fed's talking about cutting interest rates again, and what's that impact going to be on my lifestyle or my cash flow? How do I help that, or how do I address that? They may say other things. They may say, what happens in retirement when my health starts to deteriorate? My healthcare starts to go down, or my health goes down. How do I make sure that my healthcare that I have is going to be consistent and going to work best for me throughout my retirement life? When we first retire, usually we're in the best health that we're going to be. Usually we don't get better or more healthy as we retire. That's not always the case, but most of the time, Father Time continues to whack away at us, and we have aches and pains that show up as we get older. And so how do we make sure that our health care is not going to be consistent with us? Another thing that people might say is, just like my health care may deteriorate in retirement, I'm afraid my money might deteriorate in my retirement. I'm afraid I might run out of money in my life. How do I make sure that, I have these different buckets of money? I have maybe a rental or rentals plural. I have a farm account. I may have a brokerage account, or I've got a 401k or 457. I've got these different accounts. I may get a pension income. You may have all these different sources of income. How do I make sure that I blend those the best for me to make sure that my money and my health don't deteriorate as I get older, but they stay healthy until I take my last breath? So there are many things in that regard. Matt, you've heard things talk about taxes will go up. We talk about with Joshua a lot, with taxes going up, and these are a lot of different topics that people will bring up to us. Will government need more money in the future? That seems to be in the news right now with government, and and the government efficiency department. And that's kind of controversial in some respects. Some people love that, some people hate that. But the point of it is we see government waste a lot of places, and that trickles down to you and me and how much taxes we have to pay on stuff. And so these are just some of the issues that we talk about a lot.
Yeah, and we'll be talking later in the show with Joshua Sikora about why you should be looking at tax planning, because if they do lower taxes or eliminate them altogether, like some of the things Trump has said, we might want to take a look at changing some of the tax status of some of those retirement accounts. But if you don't think taxes will stay low forever because administration changes, government changes, that's a risk, tax risk over time. Sure, I'm sure you know that, right?
Well, I do. And again, you're probably hearing this, both of you guys are probably hearing this in your meetings that you have, that, hey, I've heard Social Security is not going to be taxed anymore. And whether that's on a state or a federal issue, I say, yeah, that's true in Kansas. I can't speak for Missouri, Jonathan, but that's true in Kansas. But federal is a different story from the standpoint. It may be a good talking point from a political campaign point, if you will. It's a different thing to put that into action, because the revenue that is being used from the taxes off Social Security are going right back into the system to sustain it, or to push it out, or to support it for longer viability, if you will, for people who are on it. So if they take taxes away from Social Security, which I'm in favor for, it's got to come from somewhere. And oh, by the way, we're 37 trillion in debt already. How do we juggle all these balls in the air as a country? If you're not making yourself more tax efficient and being more tax proactive, then you're probably you're not giving yourself the best favor, the best chance.
Yeah, I met with someone just this past week. She's an existing client of ours. She's no fan of Trump. She made that very, very clear. But she said, well, I'm just been surprised the market's not reacted the way it has in the first time. And that's the truth. There's a lot of different circumstances, a lot of different factors and ingredients that are going in to what's going on right now in the economy, the markets, and the world than was in Trump's first term. And guys, if you're thinking to yourself out there, if you're concerned that, like Jonathan was saying, that if you don't have a plan, if all this market volatility has you maybe losing some sleep, or let alone costing you maybe moving your retirement date, reach out and have a conversation with us at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to that website at retirehour.com. There, once you're there, you can either check out past episodes or submit a question to be used on the show. But more importantly, if you have concerns, schedule a 15-minute call with us just to have a conversation to see if what could be done in your situation and maybe help you sleep better at night. Coming up after the break, we'll be talking with Trey Bassa with Market Medicare Advisors about why someone had to leave their spouse's insurance plan, the insurance that their spouse had through their employment, their work, and had to go on to Medicare. A very interesting situation here you won't want to miss. And then, of course, at the end of the show, we'll be talking with our lead tax advisor, Joshua Sikora, on what you need to be paying attention to with tax planning, coming up next right after this. We'll be right back. Continuing, I guess, this theme that was somehow organically spun up here about risk management this week on the show, we're going to talk with Trey Bassa about someone that was kicked off they were forced to go off their spouse's workplace workplace health insurance plan. Get it in a minute. And I'm just glad you're in the radio booth, because I was concerned that I was going to be all by myself the whole show. But I think we've been remoting around with Stuart in Kansas City and Jonathan in Kansas City as well, and Danny out west. But this story is, like you said in your notes, a really specific example. And you've got your Medicare booklet here. It's like, 130 pages? And
it's quite the read.
In page 21, you found, in page 21, subparagraph C, word, blah, 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 blah. All this government stuff is complicated.
Right. The idea of, is this woman having to leave her husband's workplace interest. The idea is, and this is what happens a lot of the times, is that a significant other works past the age 65, keeping somebody else who isn't 65 Medicare eligible yet, keeping them on their workplace insurance. But this is, again, it's a very, very specific example where she has to get onto Medicare because it doesn't make sense.
So in this, well, yeah, it's the government, and it doesn't normally make sense. But in this circumstance here, in this example or this story specifically, there was, I don't want to call it like a 3-pronged test, but there was 3 criteria that all lined up, and it forced her to actually go on Medicare before age 65. That's not the norm.
It is not. There are 2 situations where you can get Medicare before 65, and Social Security disability is one of them. You have to be on it for 24 months, and then you're automatically enrolled into Parts A and B. Now, here's the catch. Now, sometimes...
You seem very excited about this. I'm just going to let you keep going.
I'm excited to learn and share what I've learned. Sometimes you can stay on your workplace, your spouse's workplace health insurance, and they will pay first. That's the coordination of benefits. You're automatically signed up for Medicare, but you can keep workplace insurance. But the third criteria, so we have under 65 disability, 2 criteria. The third criteria that caught them was that the workplace insurance was fewer than 100 employees. Now, that was a question that I forgot to ask. I know you can get disability after 24 months. At under 65, you can get Medicare. But that third criteria, that caught me, that caught a bunch of other people that they were talking with. So that criteria right there says, now that you are on Medicare, Medicare has to pay first. You cannot have a workplace insurance coverage.
So if they wouldn't have come in and talked with you, they probably would have had no idea that technically she's required to go on Medicare. Is there any kind of penalty here? I mean, what happens if they didn't and it just didn't get caught? I mean, is there a penalty?
In the short term, no, but we have to consider what their long-term plans are, especially when one significant other is still working. He's working and putting off Social Security, looking to put off Medicare until he's ready to retire, probably close to his full retirement age. But the idea I wanted to get across with this example is that there is a lot of ifs, ands, or buts, especially when it comes to just Medicare. And I didn't know the answer 100%, but luckily I had this nifty resource to lean back on to help me understand.
You don't read this when you have trouble sleeping at night, do you?
No, it's strictly just for the office.
It's great to just be an alternative to your sleeping meds, but this is just one of probably many, many, many examples we could come up with on. You don't want to be navigating this stuff on your own. And there's risks to Medicare, whether it's the penalties for not having the right coverage or not enrolling when you're supposed to or not having credible coverage. I could go on and on. But this is a really interesting circumstance that I was even unfamiliar with. You taught me something this week about if they're on Social Security disability and they're under 65 and the spouse's employer has less than 100 employees on the health plan, they are required to not be on that spouse's insurance. They're required to go on to Medicare.
Right. The coordination of benefits says that Medicare pays first. So it doesn't make any sense to have both the workplace insurance and Medicare. You're double dipping, but in that very particular instance, Medicare has to pay first. And so picking that up, coverage would be probably just more comprehensive in general. In my experience, Medicare does a lot more coverage-wise than workplace insurance. But that is my personal experience with my clients.
Well, and we've come across some people, and I had a client, she's since passed away now, but years and years ago when she was diagnosed with cancer, she wanted to keep her employer plan and she was enrolling in Medicare. She goes, I have cancer, I need all the insurance I'm going to get. And I understood that feeling. I understood that knee-jerk reaction to that. But really for Betty, there was not really any benefit to having both those plans because only one of them is going to pay, right?
Exactly. In this case, we caught it before any big changes could happen. The lady in this example is reaching 24 months this month, so we have time to start making those transitions over to Medicare just for her and reduce his payroll deduction for their work insurance. So a little bit of evening out. We're reallocating some money over to her Medicare policies, but in the long run with her Social Security disability and Medicare, I think she's going to be a little better off.
I was going to ask, how is this going to cover her? Because when you guys walk people through this process, you want a list of their prescriptions, you want the doctors that they're visiting, and you put it side by side on how they're being covered under one plan by how they could be covered under either Medicare or the supplemental plans or even Advantage plan or the drug plan, all the different stuff that can go along with Medicare. It is a puzzle. It is not just as easy as pie to switch off from your employer health insurance or your spouse's employer health insurance onto Medicare.
It can be a trying time because a lot of folks are hesitant to make the switch. They're not sure what is out there, and they're not sure how to go about making that switch. That's why we do sit down with folks months in advance to try and figure out all of these steps, establish a timeline, and make sure we know what we need to do and by when.
Well, I'm so glad that they had you as a resource that they could reach out to and get answers about their unique situation, because this is certainly a unique situation. But if you're out there listening or watching this show, let me tell you this, everyone's got a unique situation. Everyone's situation's different. And if you don't have a team that can help you walk through these issues, or maybe even someone that can help you transition from your group coverage that you're having while you're working or while your spouse is working out there and onto Medicare, reach out and give us a call at 833-MAG-REPORT. Or again, that phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to the website at retirehour.com and schedule a 15-minute call with one of the healthcare advisors to see if you could be covered any better, or if your coverage situation could be changing on you. Well, stay tuned. We'll be right back with Alex Robinson of Eidelman Law Firm talking about common fears of estate planning. Stay tuned. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape of retirement. So we've had the advisors through here, we've had the Medicare guy in, and we always end the show with the tax guy. So it must be time for the estate planning segment.
I think that's right.
Oh, you think that's right? That's what the script says. So we've got Alex Robinson, an attorney with Eidelman Law Firm. Now, you know, you and I were talking here at the break. Oftentimes there's a catalyst, there's an event that triggers people to say, hey, well, we gotta get our estate plan in order. Sometimes that's losing a family member or a loved one that didn't have something in place. Sometimes that's just us facing our own mortality. And I mentioned earlier in the show, had someone come in this week that was just diagnosed with cancer.
Right.
And that's kind of causing them to, their will I think they had was from when their kid was still under 18. So probably time to update that because he's a grown-up adult now. But there's a lot of ways people can be maybe overwhelmed with estate planning. Tell us what some of these common fears are that you've seen with people out there.
Yeah, I think, like you said, a lot of times people don't want to do estate planning because they've got some type of fear involved with it. One of the most common is that it's too complicated. You know, they've heard from a friend that they got a trust or a will or whatever it is. They've got a stack of documents this thick, and their friend says, "Well, I don't even know what any of this says."
Yeah,
and so
my situation's not this fancy. I don't need any of this stuff.
Right.
And that's not necessarily the case.
Right. Yeah. And so what we want to do is, what I tell my clients is, we're not signing any documents until you understand what's in them, because you have to be empowered and know what's in your documents so that you can communicate that plan to other people.
That's a good point. You don't want someone to just do everything for you and out of sight, out of mind, because that might not be, the plan actually might not be doing what you think it's doing.
Yeah, exactly. If you don't understand what's in your documents, it could really say anything. I've dealt with that situation several times where, you know, a spouse or a child comes in and says, "Hey, mom or dad's trust says this." And then when I read through the documents, that's not actually what it says. And so they thought they were going to get something, or they thought something was going to go a certain way. And I have to be the one that breaks the bad news to them. So we want to make sure that they understand their documents. And so even if it is complex, we're going to break it down for people so that they can understand it and really have that knowledge base to be able to share that with other people.
So while people have fears of, or maybe even reasons, maybe fear is too strong of a word. Maybe they have reasons to procrastinate. Oh, we'll get to that later. Or, oh, I've got plenty of time. What are some maybe fears that have come to fruition full circle on people that didn't have estate plans? I mean, I know you and Gerald have told me probate can cost anywhere from 3 to 6% of the total estate, and you have $1 million+ estate, you're looking at $30,000 to $60,000. It's gone like that. That's not something anyone would want to do or have their loved ones go through.
And it's traumatic. I talk about that all the time. Is you don't know what's happening unless you have an attorney that's really walking you through it step by step. You don't understand, the timelines that are involved and what creditors may or may not be out there. And so, we deal with that all the time, where we talk to someone and sit down with them and they say, hey, mom or dad didn't have a plan. I have no idea what's going on. What are the steps we need to take? And we can walk them through that. But up until they sit down with us, they're, racked with anxiety and fear because they don't understand the process.
Well, and I'm sure you have that percentage of the population or that percentage of that demographic thinking that maybe this fears this. I'm sure you have some people that think, well, I don't need that. Everything goes to my spouse and blah, 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 and I don't need something because it's going to be too expensive. To the contrary, normally what we see the expensive part kick in is when people haven't sat down and done the planning.
Yeah, quite frankly, I think of it as like dentistry. If you go in every year and you get your checkup and you're being proactive and taking care of your teeth and brushing and flossing, then you don't have these big problems down the line that cost you thousands and thousands of dollars. So if you set up your estate plan and you've got everything in place, on the back end, it's saving everyone time and money.
Now, I take offense to that. I have a nice dentist. I am not anxious about going and seeing Craig Lashley out in West Wichita, but I do not have that fear of going in and seeing my dentist. But I get your analogy. So whether you're afraid of facing your own mortality, or whether you are just putting off for tomorrow, or whether you think it's too expensive, wherever you're at, if you don't have an estate plan, or if your estate plan's older than 5 years, reach out and give us a call to schedule a review at 833-MAG-REPORT. Or again, that phone number is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to our website at retirehour.com. We'd love to have a 15-minute conversation with you just to see if you have the right things in your plan or if you might be missing something. Well, stay tuned. Speaking of missing something, we'll be right back after the break with Joshua Sikora talking about tax warnings and watches. I thought that was for weather, but stay tuned. You won't want to miss this right after this. Welcome back into Retire Hour. As we round out this week's show, we've got our tax advisor here, Joshua Sikora. Now, it rained a little bit earlier this week. We obviously need the moisture in the weather. And there was I don't think there was in Wichita a severe thunderstorm warning, but there was up in Kansas City.
Yeah, they had some activity up there.
So you're now trying to use the watches and the warning metaphors on taxes?
Well, you've made me up my metaphor game a bit here. So I thought, this works out pretty timely. So, we're hearing a lot in the news. They're talking about introducing all kinds of new tax legislation. And, whether that's going to be, Social Security is not going to be taxable, overtime's not going to be taxable, get rid of estate taxes.
Don't forget tax on tips.
No taxes on tips. They're going to increase the state and local tax deduction limit. All these things are going on. It's kind of like storm clouds on the horizon. Now, it's storm season here in the Midwest, and the one thing we do before we go out on the front porch to watch for a tornado is we turn on the TV, right? And we turn on the
see where it's at.
Got to see where it's at. When we turn on the TV to see a team of meteorologists tell us what is going on. And in the same way, there's this tax storm on the horizon. The Tax Cuts and Jobs Act expires at the end of the year.
Taxes will be changing to something. We don't know what, but taxes will be changing.
That's right, because if they don't do something, then it's going to get very expensive for a lot of people, and they're just not going to do that. And so as everything is transitioning, we're going to go through this tax storm, if you will, where things aren't going to be the way they have been. Do you have a team of people who are helping you navigate this? Now, when that storm comes in, they issue, warnings, hey, the storm is here. And then before that, though, they issue watches. Conditions are favorable for something to happen. Right now, there's a watch going on for tax changes. The conditions are favorable for there to be a change in your tax situation. And, as we're meeting with people, as we're wrapping up tax season, just about everybody I'm talking to is asking questions about how our tax is going to change. Now, that's because a lot of the people I meet with work with us together. They have a team of advisors that they rely on to weather these changes, just like we watch the team of meteorologists tell us about what's going on. And so people who either just have a tax preparer or they're using their favorite off the internet tax software, they may need somebody to talk to work through these changes before they catch you unaware. Because just like Dorothy, pedaling home, got caught unaware by the tornado and all kinds of things happened, right? And so people who are just kind of going through this themselves are going to get caught unaware, and then it's likely to have expensive consequences.
So you're telling me I can't lay you off come April 16th. I better keep you around for a little bit because tax filing season is coming to a close, there's a whole new season that's really going to be opening up for you guys in the tax department as far as when we know what these legislative changes will be. There's a lot of our clients that are really counting on us to navigate these changing tax landscapes.
Exactly. So, I mean, a lot of the people, the people I listen to who are the industry leaders kind of thing, they're talking about every estate plan needs to be rewritten that's been written in the last 5 years to account for some of the changes that they're anticipating to come out.
Well, that'll be busy for the law firm.
Yeah.
Having to really go back and revisit what's some of the why?
Well, because they're talking about what's going to happen with the state taxes. Are they going to sunset? Are they going to be eliminated? But if they're eliminated, they can be brought back. So then any elimination is just temporary. And so for people with sizable estates, their estate plans typically are written so that they can maximize the use of the exemption, then everything else goes to beneficiaries. But if the estate tax gets eliminated, then that's going to destroy those estate plans. And then what happens when it comes back in, when, the tribes in Washington change around. And so
the tribes in Washington, that's another metaphor for you. That's now you're two for today.
All right. We'll try for a three-peat here.
So this tax legislation that we know is coming, I mean, Trump was meeting with legislators this week talking about the tax cuts that they're trying to propose. You and I, Danny was talking earlier in the show about he's getting a lot of people coming in asking, well, they're going to eliminate the tax on Social Security. Well, Kansas did that this past year. Missouri, I think, did it the year before that, or Missouri beat Kansas to it. But you and I know the math doesn't math, and there's either going to be an increase somewhere or a shortfall somewhere in Social Security if they eliminate that.
That's right. And so, people ask me that all the time as we're wrapping up tax season. And I'll explain to them that, Social Security was tax-free for the longest time. And then in the early 80s, they implemented a tax on the benefits, not because they really wanted to, but because they were facing a shortfall in that Social Security trust fund. And
so you're saying this is not the first time Social Security's been projected to run shortfalls?
No, I mean, I believe it's the third time because that happened again in the early 90s. And that's where the second piece of the tax went. That made it even more complicated for people to understand. And so here we are facing it again. And so things are going to change again. At the end of the day, it's a math problem. And it doesn't really matter the things that they're saying in the news. The little sound bites we get. They've got a math problem they've got to solve. And if people aren't paying attention, then they're going to get caught surprised by the solution to this math problem, and it's going to be expensive. Whether that's going to be expensive in terms of increased taxes, expensive in terms of decreased benefits, or a combination of the two.
No. You were just saying there, it's really wide open at this point. No one really has any ideas, but probably I would make the argument, and I think I could make a pretty good case for it. This is probably going to be the most important tax planning season we've gone through this year because of what's happening with the Tax Cuts and Jobs Act is set to expire.
Yep.
If the 536 idiots in Washington can't get together and settle on a uniform tax plan, it's going to revert back to what it was in 2017, where the standard deduction is going to drop.
Yep.
You might be able to itemize again, you might not, but tax rates will be going up for everyone, not just the rich of what they say. It's literally everyone.
Right. I mean, so many of the people I meet with are maybe in the 12% bracket, maybe in the 22% bracket. Well, those will change to 15 and 25 respectively. That's automatically a 3% increase in your taxes.
And the standard deduction will come down or almost get cut in half, depends on there. And so many changes even with the estate planning. There's a lot of uncertainty out there. And right now, that uncertainty is showing up in the market. And that has to do with tariffs and taxes. But really, the one that's the silent killer here is the tax planning. If you have tax planning in your situation, reach out and schedule a 15-minute phone call to see if you could benefit from going through our whole process where we look at all the different risks, and you could maybe get a better idea of how you could maximize either these tax changes that are being proposed or that could be going up, and you need to make sure if you can do anything to protect yourself from there. So again, call that number 833-MAG-REPORT. That number again is 833, the letters M-A-G for Market Advisory Group Report. That's our process that we take people through. The report stands for the retirement evaluation process, other risks, and taxes. And we look at all the different things in your retirement plan, not just the investments. There is so much more to your retirement than just the investments, and that's what we do here as a team. So that's all the time we have this week for Retire Hour. We appreciate you watching in, and you want to do a little teaser for your taxes and taco show?
Yeah, we probably need to record another one of those where we talk about tax problems coming up, eat some tacos, and yeah.
I've got to get in on the technical details there. I need to be executive producer so I can get a taco sampling every time you guys do that.
Not a bad idea.
We'll talk about it. So that's all the time we have this week for Retire Hour. We'll see you next week.
Unless otherwise indicated, all client names have been changed to protect their identities. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns are not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. Legal services are offered by Edelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. The guest commentators featured in this show are not investment advisor representatives of Foundations and do not provide advisory services. Market Advisory Group does have several investment advisor representatives that can provide such services. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. All rights reserved.